You know what's pretty scary? The average investor earns just 5.19%, whereas the S&P 500 has an annual average return of about 9.85%. Now, how does that possibly happen? We're going to talk a little bit about the strategy, the psychology, perhaps the most important part of investing, partially has to do with dollar cost averaging, but more so with discipline in a moment. Let's check on the portfolio really quick. Things are looking pretty good in 2020 so far. It's been a good year, although we're only about 2 weeks in, but very happy so far. Things are on track. We have a plan going into 2020. The accounts are at an all-time high here, about $95,000, so we're getting very close to that illustrious $100,000, that six-figure goal that I'm really looking forward to sharing with you guys once we hit it. But perhaps the most important part of everything that we are sharing and talking about here is that there is a plan behind it. There is something that is guiding me every single week and month and year in this investing career, whatever you want to call it, this lifetime of putting money into the market and hoping that it will grow into this giant snowball of wealth. Having a plan and sticking to it is the most important part of all of this. So as I shared about 2 weeks ago, this is what I'm planning on doing for 2020. There's basically allocations to these different accounts, or I guess different expenses. I haven't completely broken that out yet. The fact of the matter is, this is set up and it's ready to go, and it's currently in progress right now. Just got paid on Friday. This is happening with my money right now. This is where it's going, and I know this is where it will be going for the remainder of the year of 2020. Obviously, a house is going to throw that off, so I'll create a new strategy if that becomes apparent. But for the moment, this is extremely important, and it speaks volumes about the success that I will achieve, because we just saw here what the average investor is dealing with, and there's a variety of reasons why this may be the case. First off, some fund managers actually have different goals than just total appreciation of the capital that they have. They might just be worried about income instead. But the point is, if average investors are making about half of what the S&P 500 returns every single year, that's terribly low. It means that the average person could be doing a lot better. And I'd argue that the most important part of that is simply doing the right thing over and over and over again. That doesn't mean making the best stock picks. It means being disciplined about your investing strategy. Now, the format that I take is that of dollar cost averaging. Now, we already know that there's a ton of reports that exist out there, kind of like this one from Vanguard, that talk about how lump sum investing is actually better than dollar cost averaging. And I don't think they're wrong about that. You can see a statistic here. On average, immediate investment outperforms systematic implementation by a high of 2.39 percentage points in the United States and a low of 1.45 percentage points in Australia. Based on this data, people are making more money by simply getting large sums in the market rather than doing dollar cost averaging. As in, over a 12-month period, they're going to put in $10,000 in January rather than putting $1,000 every single month into the market. Now, I totally understand this, and if the data supports it and you have a lump sum, then great, go ahead and do it. That's completely fine, and I support it. And in the long run, if you have a very large or long-term horizon for investing, then by all means go ahead and do it. But most of us live a different lifestyle than that. We are average investors, which is the purpose of this video. We're the average American out there working 40 hours a week, and we invest a certain amount of our money into the market. With that said, we get paid on a weekly basis or a bi-weekly basis. The best way for us to get long-term returns is most likely, the math is on our side here, most likely that we are putting a percentage of that money in every single week without fault. We are strictly adherent to a schedule and an income asset allocation that supports our goals. That's tremendously important. Now, another argument might be, why not simply save up money over a period of maybe a couple of weeks or months and then do lump sum investments into individual stock selections? And what I'd say to you is that it's incredibly difficult to do. Market timing is hard to do. Picking very attractive stocks, in my opinion, because I'm an amateur investor, is incredibly difficult to do. So if you're a normal person making a normal salary and you get paid normally, as in weekly or biweekly, simply take your money and put it in the market as fast as you get paid. That's going to be your key to success here. It's super simple, it's efficient, and it works. I've been doing it since back in 2017 when I first got out of college. And obviously, I attacked debt right off the bat, but overall, my real goal is simply saving as much as possible and getting as much into the market as possible every single biweekly paycheck that I get. There's a strategy behind this. It's incredibly simple, but it works. It works so well. But really, it all comes down to, right? It's super simple. It comes down to discipline. The fact that you're going to be looking at this weekly, monthly, or at the very worst, yearly, and you're going to be chasing these goals like crazy. So protect your money, protect your income, and hopefully you won't end up like the average investor. That's the funny thing about this. I think that the average American can easily beat the average investor we see here based on the data by simply being more in control of their finances and their investments and having some plan, even if it's just an okay plan going into the year and sticking to that plan. Because if this person just puts $500 into the market every week, they're going to do better than saving up that $500 and then trying to find some attractive stock, most likely. And I'm going for what's most likely here. Most likely, we're not going to be able to find the best stocks if we're not very, very knowledgeable about the sectors that we're putting money into. That's why it's about control, how much you save, how much you invest, and what you invest in. So focus on that, and we'll be doing pretty good in 2020. I'm excited to keep sharing these updates on a weekly basis. Looking forward to what we'll have by the end of the year. There could be a very large variable here in the form of a new house. I've actually put a couple offers out, but we'll see what happens there. So thanks so much for tuning in, guys, and I look forward to chatting next week.